Welcome to Money Hangout once again. This is our weekly interaction with you, where we try and answer some of your questions. Any investment issue that you will be anxious about, we try and address any of those issues. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to discuss about how to make your tax-saving investments as you face the deadline. March 31st is the deadline for making that investment, but you have to make it earlier if you are working, to report it to your payroll person so that he can account for it. It's just about 5 weeks now. And every year you get this privilege. Our tax laws provide that you can make some investment, and that will be, they will qualify as eligible tax-saving investment. And that could be, and the laws are very straightforward. All the eligible investments or some of the expenses that you can make, all that can be put together, and that is deducted up to a maximum of 1.5 lakh rupees, and will be deducted from your income for computing taxes. So you can look at this privilege or this benefit as getting a cashback of 45,000 rupees, depending on which tax bracket you fall in. It's almost like if you make this 1.5 lakh rupee investment, this money works for you, and you get 45,000 rupee cashback because you will save this much of taxes. So this is something which I think everybody should avail to the maximum possible extent.
And in fact, it offers twin benefit, isn't it, Dhiren? So one is the immediate return in the form of low tax liability, but the fact that it opens up a long-term investment avenue, which over a period of time can account for a substantial wealth creation for an individual.
Absolutely, and that is the intent of the government. Government wants citizens to save for their future, and that is why they're incentivizing this behavior. Incentive works with human beings, and that is exactly what the intent here is. And that is why you find that all tax-saving investments, they come with a lock-in period, so that people don't save for the short run, but they save for the long run, and for their own future. So that helps. That is actually the policy goal.
And how to go about it now, Dhiren? Then, given that the window available now is of just 5 weeks, so how can people configure their savings in this limited period of time to make the most out of the time left?
First and foremost, I would like to say that it is at all. In fact, last week I was quite surprised by, a doctorate who works in Delhi University, is a professor, and she checked with me that how to save on her taxes, and every year in March, she has to worry about it, and she's informed by her, the account person in her college that this much will be the tax deduction or whatever. When I explained her the whole thing, she was quite surprised. She was quite astonished that that this is all there to it. Is it this simple? So I think there is a lesson here that a lot of us we have not paid any attention to this. We think it is complicated. It is not complicated at all. It is very straightforward thing. Let me explain you, just to summarize and recap. Whatever be your income, you can see, if you are investing in eligible investments or a set of investment up to 1.5 lakh rupees, that money will be deducted from your income for computing taxes. The eligible investments are, your provident fund contribution, or your PPF contribution, or your term insurance, premium, or your life insurance premium. And all these things, you add it up, and if they add up to 1.5 lakh rupee, you are done with it. If you are not through, if you're not up to 1.5 lakh rupee, and you are still you're likely to pay taxes, it makes sense to actually borrow money to make that investment, so that you can take the advantage to the hilt. And now let me just list some of the simple things which you can actually take credit for. Your EPF contribution, your PPF contribution if you have still not discontinued it, your ULIP contribution if you still have not discontinued it, and your term insurance policy premium that you pay, that can be added. And then all the home loan principal that you'll be paying in the financial year, this is also an eligible contribution, or it qualifies for this benefit. So you add them up, and if they add up to 1.5 lakh rupee, you are done with it. If it still does not add up, invest some more, invest the remaining money, whatever is the leftover, by adding this up, deducting it from 1.5 lakh rupees. That is your maximum eligible investment that you can make. And investing in a tax saving fund for now, generally I suggest that do your SIP in any equity investment. But maybe this year, as you are hitting a deadline, and if you have not done it, and the very normal human psychology to postpone our most of the things to a deadline or to the last minute, make that investment now. Anyway, I think if you are going to make an annual investment in a tax saving fund, that becomes your annual SIP rather than a monthly SIP, and you don't need to average it, and you are forced to hold it for 3 years. That makes it, that forces discipline in you.
How about NPS, Dhiren? There's lots of interest from our viewers in NPS, given that it extends the limit of or to avail tax exemption from rupees 1.5 lakh to 2 lakhs. What are some of its pros and cons, and would you recommend it to our viewers?
NPS is low cost, it is efficient, but there are certain advantages. By the very design of NPS, there are 3 things which I don't like. One is that it doesn't provide you flexibility. You have to necessarily hold it for till your retirement. 40% will be annuity, has to be converted into an annuity on your retirement. 60% you can take out, of which the 40% will be tax efficient, will be tax free, and 20% will be taxable. This is one. The other thing I don't like is the asset allocation. Such a long-term investment, and you have to hold it for the maximum investment that can go is in equity is only 50%. So this is not a very efficient asset allocation. Maybe in future it becomes more efficient. And the investor not being trusted that he will not be acting responsibly with his money. I think anybody making a deliberate choice, I think that over time, a lot of these people will be a conscious investor. They'll be aware of what they are doing. They will do the right thing with their money. So forcing something by design is what I dislike and is dislikable about. And of course, you get the extra 50,000 rupee investment made. You get an extra tax break. That is the most compelling one. But when I compare it with the alternatives, assuming that an investor has a choice of making 50,000 rupee investment in the NPS and get the tax break, or paying the tax of 15,000 rupee on your 50,000 rupee investment to be made in NPS, and you invest 35,000 rupee in equity. What are the advantages? You are at absolute liberty to do whatever you want to with your money. All your gains for holding above 1 year will be completely tax free. You will not be forced to buy any annuity, anything after this. So my sense is that somebody investing 35,000 rupee in an equity fund as compared to 50,000 rupee in an NPS, that 35,000 rupee investment made in equity fund over the next 15-20 years will be far more, with far superior flexibility and control in the hands of the investor as compared to NPS. So that is why I don't like it. I don't like any investment which has to be made just for the sake of taking the tax break.